Okay, so welcome to the class, everyone. Lecture number 2. We talked about basic introduction of advanced financial management in the last class. And from today onwards, we'll be starting with the major portion. I'll be covering certain parts of your basic financial management as well, everyone, because we all know that all the advanced financial management concepts are based on that. So today we'll be starting with the investment appraisal technique. Now, if you remember, I told you about all the topics that are there in your advanced financial management. The very first topic was your long-term capital investment, or basically I would say investment appraisal decisions. We are starting topic called as basic investment appraisal decision today, everyone. I hope my screen is visible to all of you. So the topic for the today will be your investment appraisal technique. Investment appraisal. So first of all, I hope that we all are aware कि why do we need investment appraisal? Because there are different projects, right? And we have to identify which project is best for me. And to find out which project is best for me, we have to apply certain techniques, everyone. These techniques can be meant upon the profits. So if I have to say techniques, these could be either profit based techniques, or it could be cash flow based techniques. Always remember, cash flow based techniques are better than the profit based techniques. So we'll give the major superiority to the cash flow based techniques. Okay. There'll be a lot of techniques, everyone. We'll talk about each of these techniques one by one. The very first technique that we have, or I would say the simplest technique that we have, is called as the payback period. It is called as payback period, everyone. Now, when I talk about payback period, what does it mean? Ki how much time does it take to get my cash back? For example, if I'm investing 10,000 and if I'm going to get let's say 2,000 every year. My investment is 10,000, and if I am going to get 2,000 every year, what will be my payback period? 10,000 divided by 2,000, 5 years. So if your target is that you want your cash back in 5 years, accept. If your target is 4 years, reject. Okay. Now within the payback period only, but we have one more topic that is called as discounted payback. We have one more topic called as discounted payback. Now discounted payback may you have to remember one thing, guys. All the cash flows are always discounted. You will discount all the cash flows and then you will go and start solving the question, which makes question a little more interesting than the normal question that we actually solve, everyone. Great. So payback period and discounted payback period. Now over here, remember one thing. The advantages and disadvantages of all the techniques that we have are very important, everyone. So within payback period, if I have to write down a very small definition, so definition, I hope that you guys will remember. Advantage, disadvantage are of utmost important. So first of all, if I talk about all the advantages, very simple to calculate, correct? Very simple to understand, and concentrates. So if I have to put it down, advantages may simple to calculate simple to understand. Correct? Important point, everyone. Concentrates more on earlier cash flow. So, for example, you are going to get 2,000 for 5 years, but after that, you will start getting 10,000, 10,000, 10,000. Overall, may the profit looks very good, but your payback period is going to consider only the cash flow till the time of your investment, till the time your investment is received. That is one problem. So I'll just put down. Could be a problem, could be a good thing as well, right? So liquidity, uh, liquidity go it gives utmost important. That is important, everyone, right? And one thing very important, everyone, ki it gives focus on the time. So let's say if you want to make up different quick investments into different avenues, quick investment into different avenues, then definitely payback period would be good, because payback period clearly tells you ki within how much time you will get your money back. So recovery. These are the important advantages. Now coming to the disadvantages point, everyone. Well, if you guys have any disadvantages, feel free to use your chat box to pull down the disadvantages as well. I would be more than happy to read and understand something new as well. Now, what could be the disadvantages? This normal payback period does not consider any cash flow after payback period, right? So, no consideration after payback. Correct? One thing very important, ignores time value of money. The biggest disadvantage of this technique, everyone, that it ignores time value of money. Biggest disadvantage. Also, doesn't provide absolute change in shareholders' wealth. Correct? Because it just give you ki within how much time you will get your money back. It doesn't talk about ki what is the net change in the value of the shareholders. Correct? So that is one problem, a major problem, I would say. Right. Now, this is about the payback period. Another simple technique that we have, everyone, is called as return on capital employed. Should I use full name? It would be better. Return on capital employed, ROCE. Okay, return on capital employed actually tells me ki what is the percentage of return that I'm going to get over my investment. Correct? Remember this part, everyone. How are we supposed to calculate it? That is actually something very important for all of us. So the formula is pretty simple over here. You have to just pick up average annual operating profit. Remember, you will use average annual operating profit. Annual operating profit divided by, over here it could be two things, initial investment or guys, over here we can use average investment multiplied by 100. Now I'll just put a star over here. Remember, average investment will be equal to initial investment plus scrap divided by 2, या फिर investment at start, investment at end divided by 2. I'll just put that part, otherwise you might get confused. Investment at start plus scrap divided by 2. So this is the formula for return on capital employed, everyone. Return on capital employed was tested at a very high area when it was your part of your financial management. But when it comes to your normal chapter number 2, it is not tested that much. So even if you have a very basic understanding about the return on capital employed, that is okay, everyone. Just make sure that you do understand the concept, what is the meaning of it. And once again, the advantages and disadvantages are the most important area for this topic. See, I told you very clearly, this chapter, this whole AFM theoretical part is also very important. Okay, the theoretical part is also very important. I guess I should start solving this question, and I was just thinking that you might miss one area of discussion, one area over here, and most of you have actually missed that point only. And it's no one is actually correct up till now. And I know that none of you have looked at the depreciation. If you remember, I said like 3 times we have to take average annual operating profit. I have to take average annual operating profit. Okay. Now, let me solve this question, everyone. So first of all, we have to use initial investment and average investment, two things. What we need to search for first of all is the average annual profit. For both the questions, we need the average annual profit. Correct? Average annual profit is the first thing. So what is the total cash flow that we are getting? 50 in year, 100 in year 1, 50 in year 2, 50 in year 3, 50 in year 4. So what is the total cash flow? 100 plus 50 plus 50 plus 50. 200, 200, 250, everyone. That's what we are getting, right? Now, can you please look at the total depreciation? Value at start. What is the value of, let me find out. Total depreciation is how much? When we took the machine, the value was 200. When we are going to sell it at the end, the value is 20. Total depreciation is how much? 180. Now, can you tell me what is the average annual profit, everyone? So you will say, sir, average annual profit is 250 minus 180. That is annual average divided by 4. What is the value? I'm not solving this in the Excel. Excel mein beta, I'll definitely take up some tough questions. 250 minus 180 equal to 70 divided by 4, 17.5. This is the average annual profit, right? So can I go and solve my very first question, which was very simple? First point, what was the question? When I solve using initial investment. 17.5. So why 17.5? What is the formula? Average annual profit divided by initial investment, which is how much? 200 multiplied by 100. What is the answer? 0, 0 cancel out. 2, 8, 8.75. Okay, and if I'm not wrong, you guys have not considered this depreciation part, right? Most of you have not considered the depreciation part. If I start solving question number 2 now, we have to consider average investment, right? The average investment, first of all, if I talk about average investment, how much is it going to be, everyone? 200 plus 20 divided by 2. 200 plus 20 divided by 2 equal to 110. Right? Again, just have to copy and paste. So I'll do one thing. यहाँ पे I put down average annual profit. One thing. This is how I solve question number 1. This is how I'm solving question number 2. What is the formula, everyone? 17.5 divided by 110 multiplied by 100. Just solve it and you'll get your answer. 15.9. Okay, so this is how you are supposed to solve the ROCE question, everyone. I hope now this ROCE part is clear to all of you. Right? It was not something very difficult or tricky. Just there was one very basic point that a lot of you actually missed out. Now let's talk about advantages and disadvantages, guys. Let's keep it blue. Okay. Again, I would be more than happy to know advantages and disadvantages. Okay, how I got 17.5. See, what we have to do, what is the average annual profit? See, we have to calculate average annual profit. Remember that. What did you guys do? You have taken the total cash flows. Average annual profit. So how do we get to the profit? We have the sales. What is the total sales? Sir, 100 plus 50 plus 50 plus 50. We got 250. Correct? That is my average total sales, not average, total sales. Now, what is my total expense? Depreciation. Total expense is depreciation. What is the total depreciation? 200 is the value at start. 20 is the value at end. Correct? 20 is the value at end. 200 minus 20. How much is it? 180. So we just subtract 180, which is depreciation, from the sales part and divide by 4 because we wanted average. Got it? Great. Great, great. Okay, now let's come back to the advantages and disadvantages part, everyone. Advantage, again, very simple to use, simple to calculate. I'll just put down simple and easy. Simple to calculate and easy to understand. Right? Bracket I'll put down calculate and understand. Right, everyone? Another advantage of this is often used. So It is more often used for by any of the financial appraisers. So it becomes very easy for everyone to use it. When I talk about disadvantages, one of the biggest disadvantages, ignores time value of money. Biggest disadvantage, ignores the time value of money. Correct. Second point, based on profits and not cash. Profits can be manipulated, cash cannot be. Right. Target rate is subjective. Now, what do we mean by subjective? I might say that if my ROC is 15%, then it's a good investment. I don't worry about anything else. You might say, I want an ROCE of 25. So the target rate is different. For me, it could be a good investment. For you, it could be a bad investment. So that depends on the target rates. So target rate is subjective, and again, it is a relative measure. Now, what do we mean by that? Again, same thing. If you wanted a return of 35, you will compare that 35 with this ROCE. Compare that 35 with this ROCE. And then you will find out whether it's a right investment or not. So it's a relative measure. You have to relate and measure it with something else. Does not give the true change in the shareholders value. So if I can just put down this one part, does not provide, copy it, and I'll paste it over here, but a little small. Does not provide absolute change in shareholders value. Got it, everyone? So this is about the return on capital employed. So these two techniques, that is your payback period and return on capital employed, are the simplest techniques and one of the most widely used technique, everyone. Then we have a very simple concept and one of the most important concept, I would say. Upon this concept, the name of the concept, first of all, time value of money. Upon this concept, everyone, now all the techniques that we are going to study, or basically the concept of finance, is completely based on this concept of time value of money. Now, before I actually talk something about time value of money, I would be very much interested in understanding what do you guys understand from the time value of money. What is the reason behind the time value of money? What all do you know about it? You can use your chat box or you can use your mics as well, whatever you want. Okay, so let me tell you about the time value of money concept. The concept is very simple actually. The concept, as Rafit clearly said, the money value of money right now is more than the value of money after 1 year. Simple concept, right? So rupee 1 of right now is more valuable than rupee 1 after 1 year. That is the concept. Now, what is the reason behind it? Why do we have this time value of money? Basically, three reasons. If I have to define it, I can define it using three simple reasons, everyone. Oh shit, why is it not working? The very first reason is the liquidity preference. Okay, the very first reason will be, I don't know why. Liquidity preference. So people want their money right now. They want the money in their hands. Why? Because if I have 100 rupees right now, I can go and invest it somewhere else. I can get more returns after 1 year. But if I don't have it right now, I'm going to get 100 rupees after 1 year only. I have lost my potential returns, right? So this is one of the reason why value of rupee 1 or rupee 100 right now is more than 100 rupees after 1 year. Second reason, most important, that you guys were saying as well, which is your inflation, right? If I go and buy a bread of 20 rupees right now, I might be getting a 100-gram bread, just assuming. But after 1 year, do you guys really think that you will get that 100-gram bread from that 20 rupees? Absolutely not. There is something called as inflation that is eating up your returns, that is eating up your value of money. So after 1 year, from that 20 rupees, you might get a bread, but that will not be 100 gram. It will be 80 grams, 70 gram, or something less. So inflation is something because of which this time value of money concept exists. And if you are a financial manager, if you're going to manage the finance, this is something that you will have to keep in your mind as well. And this is one of the reason, guys, when I talk about returns from the stock market or returns from the FDs and a lot many areas, I keep on telling people ki, please don't put up your money in the FDs. FD is not helping you to make any returns at all. You might not be able to beat inflation. We guys are the professionals. We guys are learning this ACCA. So we need to understand how to manage our own money first. So definitely there is bond, there are bonds that we have, corporate bonds, government bonds, then we have market, then we have ETF, many more investment avenues. So you guys are the future. What I did when I was going through these concepts, when I started working in the investment bank and all, on that day, I asked my parent to stop investing in FDs. That was the first thing that I did, everyone. Make sure that you guys do the same. And remember, the market is subject, the returns on the market is subject to risk. That is one thing. And that is the third reason as well. So when I talk about what is the third reason why people prefer, why do we have this time value of money concept, you will say because of risk. Why do we have the risk concept? Very simple. Let's say if I ask anyone over here, although you guys don't know me that much, let's say if I ask let's pick up Pranav, is it okay, can you give me like 1000 rupees and I'll give it back to you tomorrow only? You might say yes, you might say no, but more or less I feel like you might say yes. Ki, okay sir, you can have 1000 rupees because you are going to return me tomorrow only. Right. But will you be okay if I ask you money and I'll say that I'll return it back to you after 1 year or after 2 years? Then you might think, yeah, what will happen if he doesn't give me the money back? I don't know. I will not be able to keep a track of him for 1 year, for 2 years. So the risk actually increases. Cash which is received today is safe, or after 1 day is safe. But after 1 year, after 2 years, is it going to be safe? That is a big question mark. So these are the three reasons why there's a time value of money concept that exists everywhere. Now, this is the one thing. If you remember, we talked about techniques, everyone. So cash flow profit techniques, we talked about two techniques, right? What were they, everyone? We talked about ROCE and we talked about payback. Payback को I will not take it up. Why? Because payback में some people use cash flow, some people use profit. Cash flow based techniques में again we have two techniques, everyone. One is your net present value, one is your internal rate of return. But this is the basic that we are discussing right now. Okay, we have not discussed, up till now we have not discussed the advanced version, that is a part of AFM. Okay, so this is something that we have to remember as well. Okay, coming back. Now we have number of things that we have to consider. Now you might think what is the time value of money and how to actually inculcate this. So we all know what does it mean. Basically, first of all, I'm not very good at drawing, everyone. So let's say we are receiving rupees 100 after 5 years. And now I want to find out, I want to find out the value of this thing at year 0. Remember everyone, today I will call year 0. Today is called as year 0. What is the value of that? How can we find out the value of that thing, the value of $100? Note down the formulas, everyone. The formulas are going to play a very vital role for all of you. So we will be using a formula for that, everyone. Now there are two things. If we have a single cash flow, so you will use a formula which is 1 upon 1 plus r raised to the power n. This is the formula. 1 upon 1 plus r raised to the power n, where r stands for rate, n stands for time. Okay, this is the single cash flow. Now, when I say multiple cash flow, which is also called as annuity, remember, multiple cash flow or simple language pe annuities. Now, what is annuities, everyone? You are going to get the same cash flow on a regular basis. Same cash flow on a regular basis. So you will use a formula which is called as 1 minus 1 upon 1 plus r, 1 minus bracket में 1 plus r. अब यहाँ पे raised to the power is minus n upon r again. Okay, 1 minus bracket में 1 plus r raised to the power minus n upon r. Now this formula looks very different, correct? If you look at this formula, you might get confused. Guys, can you please open the formula sheet that I have shared with all of you? Can you please open that formula sheet? Uh, Now, if you look at the formula sheet, everyone, okay, where is that formula sheet now? Would be nice if you can share the formula sheet with me as well. Where is it? Where is it? Oh, I'm not getting the formula sheet. I'm doing some, I'm using a different area. Pencil or traffic, although I'm using a different avenue now. Okay. So this was your formula sheet that is given to you. Now this will be available in your exam as well. My suggestion to please remember all the formulas rather than just following this one blindly. Now over here, if you notice, we have the standard normal distribution table. Where we are supposed to use it, I'll tell you little later. This is the present value table. So if there are like different cash flows in each year, like 100 in year 1, 200 in year 2, 300 in year 3, 400 in year 4. So you might use that single cash flow formula, which is 1 upon 1 plus r raised to the power n. Or let's say the percentage is 6% and you're supposed to find for year 1, you will use this. Year 2, you will use this. Year 3, you will use this. Year 4, you will use this. So now over here, why I suggest using formula? Because for every year, you will have to find out a different percentage, copy it and paste it in your Excel. It will take time. Okay, it will take time, everyone. So for single year cash flows, this table is great. When I talk about multiple cash flows or the annuity, multiple cash flows or the annuity part, everyone. Over here, let's say at 10% for 5 years. What does it mean? Ki, for the next 5 years, I am going to get the same cash flow. This is the meaning of annuity, everyone. For the next 5 years, I am going to get the same cash flow, which is 100. So I'll just multiply 100 by 3.791. That's it. 100 multiplied by 3.791. And I'll get the present value of my 5-year cash flow at year 0. Okay, so for annuity table, use this. For annuity, calculating the value of annuity, use the table. For single period cash flow, use the formula. Okay, it is better actually. It will be very much easier for you guys only. Now, one more thing, that is your perpetuity. Perpetuities, or I'll say perpetuity, or you call it perpetuities as well a lot of times. Yes. I added just a perpetuity. Okay, perpetuities. Now, as per concept of perpetuity, you are going to get a cash flow, a same amount of cash flow, but for X number of years. You are going to get the same amount of cash flow, but for X number of years. Are you getting my point? So, matlab X number of years coming, there is no end. You don't know the end. Okay. Then what you are supposed to do? Use the formula. The simplest formula that we have, 1 upon R. That's it. 1 upon R. You don't have to do anything else. As simple as that. Right? Now, what will happen if there is a non-annual cash flow? Are you getting my point? If the cash flow is about to incur in 3 months, then what will you do? So now you have to discuss about the number of periods per annum. So for the concept of non-annual cash flow. Non-annual, generally guys, up till now, whatever we have discussed, it was a annual cash flow. When I'm supposed to discuss non-annual cash flow, how do we calculate the discounting factor in that case? That's a good question, right? For that, we have a very simple formula again, everyone, which is 1 plus R equal to under root 1 plus R raised to the power N. Are you getting my point? 1 plus R N raised to the power 1 plus R. If there are non-annual cash flows, generally it's kind of new. This topic is kind of new, not tested or a lot in the exams, but still we need to have an idea about it, everyone. Up over here, there are 2R. Okay, I'll do one thing. I'll change this R because this is what we are calculating. Okay, this is what we are calculating. Up over here, this small r is the periodic discount rate. So for 3 year, 3 months, 4 months, 6 months, 8 months, for that amount of time, what will be the discounted? That is a small r. Capital R is your annual discount rate. Annual discount rate. N will be equal to the number of periods per annum. Number of periods per annum. For example, if I am asking you to calculate discount rate of 6 months, so how many number of periods we have? 2. How many number of periods do we have? 2. Let's do a question on this. Assuming that a cash flow will incur in 3 months. Okay. Cash flow will incur in 3 months time. Strong. 3 months time. And annual interest rate is given as 10%. Can you calculate this question, everyone? Okay, let me show you guys. 1 plus r, this is what we are trying to calculate. So I'll put down 1 plus r equal to under root to the power. Now 3 months. Cash flow is happening every 3 months. So what is the periodic? What is the periodic percent? Matlab, total months is 12th. We are getting the cash flow every 3 months. So what are the total number of periods? 4. I guess you guys are taking 3 over here, right? So that's what the problem. Number of periods per annum. I told you over here as well, yeah. Right? So it will become 4. Bracket में 1 plus r. 1 plus r. R is 10. 1.1. Right? Bracket में 1.1. Now, can you solve it? Point 1 raised to the power. How much are you getting now? Did you got the answer now? 2.41 for me. It should not take this long, guys. See, if you have Excel, what you can do is simply go to the Excel, put equal 1.1 raised to the power. Now it is 4 power to the under root power 4. So just put down 1 divided by 4 raised to the power 1 divided by 4. This is how you're supposed to solve this question on based on the non-annual cash flows. Now, coming to the most important part, which is your net present value. How are we supposed to solve the net present value question? That is going to be very important. Now, guys, when I talk about net present value, we have to understand that it considers the time value of money. That is why it is one of the best ways of solving any question or analyzing any project. Net present value. Okay. NPV is considered as the most relevant technique in the business decision making, everyone. I hope that you guys are aware of the pro forma and everything. I'll do one thing. I'll just copy paste it once so that you guys will have an idea of it. Okay. So we have the investment or the asset capital expenditure, then whatever the sales. Guys, remember one thing, not just one thing, few things over here. Investment is generally made at year 0. Investment is generally made at year 0 only. profits or the cash or the revenue start coming from year one. Okay. So these are the one thing. I will, let's say there is something which is given as the revenue will start from the start of next year. Start of next year. We will consider it as a end of current year. Okay. It will be given as end of current year. This is one thing which is very important. So always remember the cash flows which are given over here. Na? Guys, the cash flows which are given over here, they are at the end of year. They are at the end of year. Okay, now you might have a question on the decision rule over here. We talked about ROCE, we talked about payback. NPV, mein guys, you remember one thing. The decision rule is the simplest over here. If NPV is positive, you accept the project. If NPV is negative, you reject the project. Okay. If NPV is positive, accept. If NPV is negative, reject. Simple as that. Got it? Now we have one more topic over here, net after net present value. Very good topic, I would say, and a very similar topic actually, which is your internal rate of return, everyone. Acha, one more thing, everyone. When I talk about Excel, you are supposed to solve this in Excel. You will have to put down formula equal NPV, whatever is the rate, and then cash flows. Cash flows is starting from year one. Cash flows starting from year one. This is what you're supposed to do in Excel. Okay. Then we have internal rate of return. Internal rate of return. What does it mean? The discount rate at which my NPV is 0. The discount rate at which my NPV is 0. This is what is the meaning of internal rate of return. Absolutely. The spreadsheet which is given by ACCA, the formula of NPV, the formula of IRR, the formula of sum will be working and is acceptable by ACCA. Even ACCA asks us to go and put down these formulas. So if you remember, guys, there is something called as professional marks. I'll talk about it although later, but you guys have passed the paper. Professional marks are awarded based on these things only. Okay, based on these things only. Right. So how to get the decision rule of IRR? Remember, if IRR is greater than cost of capital, then you will accept. If IRR is less than cost of capital, you will have to reject. Now let me tell you why. But a cost of capital will be the discounting factor. When solving for NPV, cost of capital is your discounting factor, right? So let's say my IRR is 10%, and when I'm using 10%, my NPV is 0. So if my cost of capital is more, let's say it is 12%, so my NPV will become negative. So that is why we have to reject it. Up to solve IRR, we have two ways. First of all, beta, we can use the general method or the formula which is given. The formula that is uh, lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate multiplied by higher rate minus lower rate. Looks very difficult, I understand, but the best part, we will never be using this formula at all. Why? Because we have an Excel formula for that, guys. Good thing actually. So we have to just put equal IRR, bracket open, take up all the cash flows from year 0 to infinity, whatever X number of years, and that's it. You have to do that. You don't have to worry about anything else. Okay. This is how you can solve this question on IRR. I should not talk about this part right now, but there are like number of problems in IRR. There are number of problems in IRR due to which there is a function or there is a method which is called as modified internal rate of return that we'll talk about in the later part of class. Basically, the problem with the IRR is that there can be a situation of multiple IRR. Correct. There can be a situation of multiple IRRs. I can take different NPVs. I can take different high discounting rates, and I can get number of IRR. So this method will not be of any use, right? This method will not be of any use. Which bring us to one concept or one topic that has been tested like number of times, everyone, and you need to be ready for that as well. The topic is NPV versus IRR. Again, this is something that you have studied in the previous classes as well. I'm just highlighting it. Okay. Now, what are the differences between these two? NPV, absolute measure. It will directly tell you whether you should accept or not. IRR, again, a relative measure. You have to measure against cost of capital. Correct? NPV may direct answer. Over here we have relative measure. NPV shows me the change in the shareholders' wealth. Remember, NPV shows me change in the shareholders' wealth. IRR does not show that change. Okay. NPV can be only one, IRR can be multiple. NPV is always reliable for decision making. IRR is not that reliable. Okay. You just need to remember this part. I'll just put down a quick summary over here for you guys. Yep, now it's better. NPV versus IRR as well. Now we have NPV versus IRR function as well. Okay. So there are certain rules. Let's come to a little on to the theoretical part. Okay, a little on to the theoretical part, which actually talks about discounting, right? If we talked about this process of from coming from year 5 to year 1, but this method is called as discounting. Okay. Now there are certain rules. First of all, we have to only consider cash flows which are, that are affected by a decision and which are relevant to the decision. Means using only future cash flows and incremental cash flows. So I'll just put down. So I just put down rules for cash flow based technique. Next bracket I'm putting down NPV because we will be using this technique for the majorly for the NPV. So rule number one, using only future or incremental cash flow. Okay. Now, incremental cash flows are those that change because of the project. So, what are the incremental cash flows? Those that uh, change because of project. So, if there is a particular cash flow that is not getting affected at all because of the project, you don't need to take it. There is no requirement to take it. We are not supposed to include financing cash flow. Don't include financing cash flow. Interest is not required. Why? Because better when we use the discounting factor, interest is already considered. Okay. So what all we need to exclude first sunk cost, the cost that is already spent. For example, let's say you wanted to invest in a particular project. You have project A, project B, project C, but to find out that you can invest in project A, project B, or project C, you did some study. And in that study, you had invested some money. That money is called as sunk cost. Why? Because no matter whether you take that project or you reject that project, whether you accept any of the projects or you reject all of the projects, you are going to do that study. So that is an example of sunk cost. Then we have non-cash flow. Depreciation. We are not required to consider depreciation while maintaining that NPV format. There's no requirement for that. Don't consider book values. For example, inventory values of FIFO and all that, right? Then any unavoidable cost. If there is any unavoidable cost. For example, money that is already spent, already committed, we are not required to use it. So remember these because ACCA will try to confuse you over here. Also, include opportunity cost as well. Always include opportunity cost. Okay. For example, let's say because of a launch of a particular product, let's say product X, the you are going to stop product Y. Okay. Now, because of that, the sales of product Y will fall, right? The sales of product Y will fall. So definitely some profit will be lost. Please include that amount. I'll just highlight it for your reference. Ensure that you include these things. Always include opportunity cost. Okay. Then while solving this cash flow based technique, we will have tax as well. We have to consider the tax as well, everyone. And now when I talk about tax will have two effects, right? Tax will have two effects. So now the heading will go about taxation. First, we are supposed to charge tax. That is a simple thing. We don't have to worry about it. But there will be something. So there is something called as tax charged. Second thing, which is more important, is the tax allowable depreciation. The tax allowable depreciation is always added. I hope all of you are aware of what is tax allowable depreciation, but still I'll give you a summary of it because beta we are not charging depreciation, right? So what will happen if you're not charging depreciation? My profits will be higher. Because of my high profits, I'll be paying a higher tax as well. But I'm not supposed to pay that much tax. So what will happen? I find out what will be the value of my depreciation. I find out ki because of that depreciation, how much tax will I save, and I reduce my tax from that value by that much value. This is how I use it, everyone, and this is how we are supposed to use it. For this, we create a specific working, everyone. Okay? We have to create a working for this. Okay, there are certain assumptions over here that the tax rate is constant, tax deduction is full, tax deduction can be in arrears, and arrears means after 1 year or can be on the same year as well. Working capital will have no effect on the cash flow. So once you calculate the tax, then include the working capital. Now, one point which is very important, everyone over here, which is called as tax exhaustion. It can happen. Tax exhaustion is a situation that can come in if the company does not have sufficient profits. If the company does not have sufficient profits, they will not be able to use tax allowable depreciation. Are you getting my point? Because if they use it, it can lead to a tax loss. Remember everything, everyone. Tax loss can be carried forward against profit in previous years and against profit of the future years. Are you getting my point? For example, let's say 1, 2, 3. Year 1 pe beta I had a loss of 100. Year 2 may I had a profit of 200. Year 3 may I have a profit of 150. Will I pay any tax? No. Over here, I will pay tax only on 200 minus 100 only at 100. Over here, I'll pay tax at 150. Simple situation, right? Tax can, matlab, the loss can be carried forward. Losses can be carried forward for taxation purpose. Now you might have a question, sir, what will happen if in year 2 I have a profit of 50 only? Year 2 may again you will pay zero tax. Year 3 pay you will 150 minus 50, you'll pay tax on only 50. Got my point, everyone? See, so it will be given in the question that whether the losses can be carried forward or not. Okay, it will be given. If it is given only, then you are supposed to use, otherwise it's of no purpose to use it. So this is one thing that we have to worry about. That is your taxation, everyone. No, there is no cap on the carry forward years. It can be taken to as many years as possible. Generally, when I talk about exam, it will be carried forward for 2 years, maybe not more than that. But yeah, one thing, For different jurisdictions, they might have their own local rules that might not allow carry forwarding for more than 3 years, for more than 4 years, for more than 5 years. So when you guys will be learning about the ATX examination, that thing is covered in depth over there as well. So let's talk about inflation, everyone. This time value of money concepts came in because of inflation, and we need to take care of that part as well, right? So all the cash flows that are given, we have to inflate it. Is it compulsory? Absolutely not. So because of non-compulsion, we have two types of rates. One is called as real rate. One is called as nominal rate, right? Real rate and nominal rate. Guys, if you are inflating your cash flows, make sure that you are using nominal rate. If cash flows are inflated, if cash flows not inflated. Okay, remember this. Real, we are supposed to use if we have not inflated, if the inflation is missing. Nominal, we are supposed to use if the cash flows are inflated. Now, let me tell you how the exam will ask you a question. They will give you a real rate. They will ask you to inflate everything, and they will ask you to calculate the nominal rate and then discount. So for that, guys, remember we have a formula which is very simple. The formula is 1 plus I. I का मतलब nominal rate equal to 1 plus R multiplied by 1 plus H. Okay. Ab, just for the sake of simplification, I call it NRI. NRI. Nominal real inflation. Just for the sake of remembering this formula, NRI, yani 1 plus nominal rate is equal to 1 plus real rate multiplied by 1 plus inflation. But inflation can be of two types, remember, specific and general. Inflation can be two types, specific and general. Specific inflation is that which is only inflating particular item. For example, if I say the inflation rate at wages is 5%, that is specific. If I say the inflation rate at material cost is 6%, only that. Okay. General inflation is that which is applicable in everywhere. Okay. So now let's assume in the question it says specific inflation is 5% on materials and general inflation is 7. So beta, on materials only you will use 5%. Other than that, you will use general inflation everywhere. If general inflation is not given in a particular question, there is no requirement to use it or to go for it. It's pretty much okay, everyone. Okay. So you are supposed to inflate the cash flows and then you're supposed to solve this. I guess we can do one question onto that. Let me cover theoretical part once and then we'll move forward. So this is about the inflation. See, we will solve one question that will include your tax allowable depreciation, your tax, your inflation, and then your working capital as well. Uh-huh. Okay. Now, working capital is very simple. Just a second. Working capital is very simple. Again, you have to create a separate working for it. You might have to create a working for it, for working capital as well. Just remember one thing. That you have to consider only the increase or decrease in working capital. Guys, you have to consider only the increase or decrease in working capital. At the end, always remember, at end, working capital is released. At the end, working capital is released. The working capital will have no tax effect. No tax effect on working capital. Okay. So these are the certain things that you are supposed to remember. We'll solve one question that will include all of these things, everyone, which will make things a little more easier for you. Okay. Now, whenever you go and invest in any particular machinery, any particular project, many things will change with that project, right? So generally, solving part is one thing that we have to consider. It will change your non-current assets value, might change your depreciation part, profitability part as well. So just remember ki if I'm investing in a project, what will be the impact? Depreciation could be there, revaluation could be there, impairments can be there, non-current asset could be there. Many things can happen. And not only that, investing in a project is not that easy. You might have to finance for it. It could be with the help of equity financing, or you might have to go for a debt financing, right? So because of that, what could happen? Certain other ratios can fall. Are you getting my point? So a lot of things can change because of just one investment or the one project that you are taking. Right, everyone? Now, my homework for today, remember everyone, first of all, you are supposed to go and solve quiz of chapter 1 in your ACCA study hub. There is an option of quizzes, everyone. Let me show you that. So total we have 18 chapters in there and we have 18 quizzes. Every quiz have 5 questions. Just go and solve that much only. Okay. Then you have other practice questions, like 2 questions from every chapter, or 4 5 questions from every chapter. Chapter 1 pe beta we have 2 questions. Please go and solve that as well. Okay. So you have to go solve quizzes and practice questions for chapter